Thanks for joining our Westcliff webinar, Thrive in 25. This is one of many series that we've been doing this year. Today, we're really excited to have the team at Faris Capital Partners join us for a webinar talking a bit about U.S. multifamily investing. The agenda for today will give you a bit of an overview on Westcliff and what we do as a business. I even get to know Mark and John a bit better from Faris Capital. So I'm joined here today with my trusted business partner, Adi Saeed, who is a registered dealing representative and a longtime broker. He and I have worked for many years together, and myself, my background over 20 years in real estate, finance, and accounting, working very much in all aspects of the capital cycle. I'm also a registered dealing representative, working directly with Adi. The Westcliff side, our business is really focusing on our ethos, which is really around learn, invest, and manage. And so we take a lot of pride in helping and educate investors from both a passive and an active perspective. That's really what our learn ethos is. The webinars such as this, content that we put out online, a big part of it is helping our investors and folks in general learn more about the benefits of investing in real estate. The second pillar is around invest. And so that is really where, we bring and we have access to exclusive market opportunities, whether they're active or passive. We're able to help you find ways to deploy your capital. And then on the managed side, really, once you've made those investments or if you have existing investments, we have a full team that helps you from an asset management perspective, integrated property management, accounting, finance. So really just helping you manage those finances on an ongoing basis. So again, if you want to learn more, you can reach out to us at www.westcliffam.com. And let's look forward to having a conversation with you. So today, as mentioned, we've got Mark Faris and John from Faris Capital. Thanks for joining us today, and we're really glad to have both of you on the call. Mark, tell us a bit more about your background and your journey, and maybe the listeners who may not have heard of you can learn a bit about yourself.
Yeah, it's great. Thanks, Kaz and Adi, for having John, myself, and Faris Capital on. It started back, actually, I grew up on a farm just north of Cookstown, so north of Toronto, for those of you that haven't heard of the little tiny town of Cookstown. But grew up, typical Canadian playing hockey, rose through the ranks and played overseas in Sweden and down in the U.S. in the Central League for a couple of years. I walked in one day, was put on waivers. So I was recently married, and this was back in 2007. And at that point, it was very clear that hockey wasn't in my future, and jumped into real estate. I started at Royal LePage back in 2007. My wife has a very strong marketing background. So we started there, and early struggle, as many of you, if you're entrepreneurs or you started anything, there's that early struggle phase. Well, we definitely went through that. And then we scaled the company up. We started just as an agent, and then we brought on other agents. We trained them, became the largest real estate team across Canada, Royal LePage, for 5 years, and then we transitioned to our own brokerage, Faris Team Real Estate Brokerage. If you've driven north of Toronto, you might have seen our signs, the blue suit. And so through the years, we've sold over 13,000 properties and over $8 billion in sales. Now, we worked with thousands of investors along the way, and we had been investing in real estate across Ontario and single family, multifamily, and our office buildings as well. And when COVID hit and pricing went up, it posed a real challenge for us as a real estate team, because investors would come to us and say, hey, listen, I want to invest in real estate. I love real estate. I want to invest. And maybe they're pulling some home equity line of credit from their existing home. They have equity there and they want to go buy an investment property. Well, the big challenge for us was we couldn't find any great deals for them anymore. And so we were sending them, to Midland and really for a while, the smaller tertiary markets. And then it got to the point where we're like, we got to send you way up to Sudbury to find properties that would actually carry themselves and cash flow, because I'm a big proponent of cash flow and appreciation as well. So I like both. And so that really, guys, that was like the birth of Faris Capital Partners. We had transitioned from Ontario down to Florida, and we had been moving back and forth, my wife and myself and my 3 boys. And that's actually when we realized that real estate down in the US, Florida, South Carolina, Atlanta, Georgia, it reminded me a lot of 2008, 2009. And then I started looking at the larger multifamily properties, 100 unit plus. And I said, you know what? Canadians need access to this. And so I'm going to pause it there, guys, because from there, it was a really cool story and how we've been able to take it and then build into the assets that we have and build the team that we have as well.
Awesome. And you're joined by John today. Why don't you introduce John? Maybe you can introduce yourself and what your role is at Faris Capital.
Yeah, absolutely. So very similar to Mark, I actually started my career in residential real estate, just skipped the hockey thing. I wasn't a big sports guy in college. I played a lot in high school, but got licensed at 22 and just started selling residential real estate. And when the Great Recession hit in '08, the company I was working for just kind of felt like they had their head in the sand. It was like, well, let's just keep doing what we're doing. It'll all work itself out. And meanwhile, my income was cut in half. So there was actually a gentleman named Mark Spain in my market who had billboards up. And I just said, gosh, the guy has billboards up in this market. Something must be working out for him or working well for him. So we ended up connecting, joined up with him. And to cut a long story short, over 15 years, started off as an agent, but was quickly given some management responsibilities and eventually became president and CEO of our own brokerage that we created, Mark Spain Real Estate. And we scaled the operations across the Southeast and had a private equity exit in 2021, nine-figure exit. So very exciting, learned a lot. I was kind of the day-to-day operator of the business. So building out the systems, the infrastructure, working with the expansion team, just overseeing all aspects of the operation. So when private equity comes in, it was an exciting time, but it just changed. And I'm a builder, I'm a grower. I like to innovate and to create. And it kind of felt like, great, we know it works. Let's just keep doing more of that. And so after 2 years, that was part of my agreement when they purchased, I decided to look at other opportunities. Now, Mark Faris and I had met a number of years prior to that, just as similar operators, but just in different markets. So we formed a relationship where we could, share, practices that were working really well for us or discuss challenges. And so through that, we really learned a lot about each other, like our morals and our business ethics and how we treated our teams. And so we would have these like monthly and sometimes quarterly calls if we got busy. And so I said, Mark, I left Mark Spain Real Estate. And before you know it, we're talking about his idea here for Faris Capital Partners. So, Mark is the visionary. He's the tip of the spear with our investors, building long-term relationship with all our investors. Our mission is to go full out for our investors and to provide the best investing experience in the world. So that's really where Mark focuses his time. And then I'm focused on the operations of the business, the acquisitions, the marketing, and the asset management. So it's a great business partnership, and we're excited to share some of the successes we've had so far and where we plan to go in the future.
That's amazing. If you guys can give me an elevator pitch why Faris Capital is different than and the pretty crowded space of investment real estate today, what sets Faris Capital apart from others?
Maybe I'll start, John, and then you can kind of pick up anything that you think you'd like to add. So first off, for Canadian investors, there's really, from what I've been able to find, to be able to come in and actually partner on these deals and get the kind of upside that we're offering is very, very rare, if not non-existent, that I've been able to find. So to be able to structure it for Canadians to do it tax efficiently is something that we really prioritize. And we spend a lot of time building the structure to be able to do that. So that's first off. Second off is the team that we built in the execution. We're going to talk a little bit about this 28-day full-out transformation plan that has, over the last 4 assets that we've closed on, have been allowing us to overshoot our projected rents. So that's really the canary in the deal, as if you're hitting those and exceeding those, that the overall return metrics that we had projected are very conservative, if not surpassing. And so the team that we've been able to build is something that I'll allow John to talk a little bit more about that. But then the execution side as well, with the value add approach and how quick we move when we take an asset over, we'll be diving into that a little bit more. John, anything to add to that?
Yeah, I would say this. So when Mark and I first started initially talking about this, it happened pretty quickly for me. I'd kind of planned to take 9 months off and just kind of reset. But candidly, I got pretty bored of hiking every day and reading books. And, kind of my kids were in school and my wife was at work. And I'm like, okay, maybe this 9-month thing is no good. I need to get back into action. And of course, I love Mark. And so I was very excited about this opportunity. But one thing that really caught my attention on the front end, I'm an investor myself. And he had shared a story about, a startup he had invested in, and like come to find out that the company had gone bankrupt. And if I'm not mistaken, I'm remembering the story from a few years ago, like you learned about it in the newspaper, right? Nobody called to share with him that there was trouble along the way, let alone this bankruptcy. And so I had personally had experience with investments where communication was limited, if non-existent. And in some cases, it was still a good investment, but I just felt like I was like out on an island with no information. And so Mark talked about this goal of that incredible investor experience, like guaranteed communication. And so that really resonated with me. And then the second component is we put a lot of focused attention on the resident experience. We want to make sure that our residents feel the love. Our leasing centers are open 6 days a week. We have guarantees so that they know if they have a maintenance request, it's going to get done in a timely fashion. Otherwise, we will pay them. We give them like a Visa gift card and a few others related to, life changes that may impact their ability to pay rent, making it easy for them to get out of these leases. And so that kind of focus on the resident and that focus on the investor was something that was really important to me because all the success we experienced at Mark Spain Real Estate was driven by our model. We did all the marketing and lead generation. So our agent's sole role was customer service. It was just doing a great job for that client. And Mark's business at Faris team, his residential business, was structured very similarly. So that ability to do what we'd already sort of done in the past at other businesses successfully and apply it to just this new kind of thing, right? This investing model was very exciting for me. I'm a big believer in that Zig Ziglar philosophy. You'll get what you want when you help others get what they want. And so it felt like that's exactly what we were building here at Faris Capital.
So you guys have raised about $50 million so far. You got 500 plus residents, 175 plus investors, and you're looking to inject $1 billion of Canadian investment into the US real estate market. Those are some lofty numbers, or is this stuff that you're already achieved already?
I was just going to say, so that $1 billion, that's our 10-year goal. So that's where we'd like to get. We want to serve 10,000 residents and serve 2,500 investors. So that's sort of our overall North Star. That's what every day we're looking at. We have a vivid vision we've created, which is a 3-year goal, but that's that 10-year big, hairy, audacious goal, BHAG, as you might hear it said. But yeah, 175 investors that are fully in on our deals. I would say the majority of our investors are in multiple deals with us because they've appreciated our style of communication and our proactive approach. That billion, we've got a ways to go, but that is that North Star that we work towards every day.
Can you talk a little bit more about your core values that you're mentioning over here?
Yeah, maybe I'll set the stage there for that, John. So I saw through the years that one of the biggest things when people would come work for us in our companies, they would say, hey, there's just something different here. Something different. And so as we started scaling up, we have over 100 team members, you start to realize that you got to create some sort of we'll call them decision-making filters, right? That everybody can make similar decisions to create alignment within an organization. And so I started to really buy into these ideas of values because when I ask people what was it about here? They're like, just something different. Like, what is just the people are different. And what we realized was these core values that we had created and started talking about and living and breathing and hiring people based on them and letting people go sometimes when there was a misalignment in values as well became at the core of our culture because culture is talked about a lot. But what's really interesting is that culture needs to be curated and it's a living, breathing thing. You got to constantly be on it. And so getting really clear what the values are is one thing, but then injecting that on a daily basis. And we have a number of different things that we do in our prior company. And that's where John and I, when we came together, we kind of locked ourselves in a hotel business center. And the two of us in the big office, we created our core values and our brand promises and our mission, our BHAG, and we mapped everything out. And then it was like hardcore execution on building the team. And so what's really cool is that not only do we have this for a full-time team of 8 for Faris Capital, but we also taken these same values and we actually install them and implement and breathe it into each of our communities that we close on so that each of the communities have our mission and the core values as well so that the residents can feel that on that end. So John, maybe you can kind of explain each one at a simple level here and maybe we can move on from there.
Yeah. And the way Mark touched on filtering, so these are in order of importance in a sense, right? So genuine love of people in a sense speaks for itself, but we only want team members that truly care about people. So a great example, we had a hurricane come close to one of our properties. In fact, we had no actual issues at the property. The properties we buy in those areas, we always buy in floods. I'd say in an area that does not flood. So there's no flood insurance required, does not have history of flooding. So we buy right, but still scary for those residents. So proactively going around unit to unit and asking every resident, do they have a plan? Do they have batteries? Do they have what they need? Helping supply those things if necessary, giving them a checklist to be prepared, and then proactively checking after the storm to ensure everything was great. Another example is food prices have gotten very expensive with inflation. So we have a monthly farmers market that our vendors co-sponsored. Every resident gets $50 in free groceries, and then they can buy additional. So just those kind of ideas of really loving on the residents, because at the end of the day, if we can maximize our occupancy and keep people renewing and accepting those rent increases, then we're going to maximize our NOI and our return to the investors. Making wise choices, right? What that looks like is seeking out counsel. So we have some coaches and business consultants we work with, reaching out to our vendors like our attorney and our accountants on both sides of the border, running ideas past them. First class service, right? That goes back to that mission of that going full out and providing that best investing experience in the world. So obviously, in a sense, that speaks for itself, but we've systemized that with programs and structures. So like after a conversation with an investor, a follow-up email goes out. And then, of course, operational excellence and speed of execution. So the idea is that we would never sacrifice that first class service to move quickly, or we would not go so fast that we, don't operate with excellence. But those are the values, and then we filter through those values as we make decisions. Is this the right initiative for the company, or do we need to take a step back and reevaluate it for a better approach? So that's how those values are applied at our company.
That's great. Can you give us a rundown of what your thesis is? So you had a problem that you were trying to solve. The problem was that in Canada or in Ontario, the investments that were available at that time weren't cash flowing or weren't sufficient for a sufficient type of investment for your clients. So you're looking into the US. So what's the overall thesis that you're looking at?
Yeah. So again, I'm agnostic to the location that I invest, are my own personal dollars, but then also our investors' dollars, as in whether it's in Canada or the US, it's really about what is going to be the best overall approach to not only protect capital, but to grow it as well. And so real estate has always been my vehicle of choice. I'm not saying it's for everybody. I think it's for 90% of millionaires. They've used it. And so it's been proven through the years. And so I love real estate. That's actually why I became an agent, to learn more about it back in 2007. And so what we found was that multifamily in Ontario, there was a really big challenge where we could only there's rent control. So you can only raise rents by, this year is like 2.5%. During COVID, it was 0. And we do have some assets still in Ontario that in some case, we have this one situation where there's an 8-plex, and 7 of the units have been renovated and they're getting over $1,700 a month. And one of the units are actually getting $650. And we've offered them $30,000 cash for keys. And he knows the game, and he's come back and said, I'm not moving out for $1 less than $100,000. So for us, that was too much of a risky move to go buy a large apartment building to run up against that kind of pushback. And it was just swimming against the current, so to speak. So this is where these assets that we find down in the Southeast, there's no rent control. Properties are cash flowing from day one. And there's very strong upside because people are actually moving there. And we're going to talk a little bit about the migration patterns here in a minute. But moving to and buying in areas that are about to hit and opening it up and saying, okay, if you're agnostic to all across North America, where are people moving? And it's interesting, if you look at heat maps in the US, you can see from the blue states, they're moving to the red states, and you can see the heat map where people are actually moving to. So this is where we go in, we find an asset, we have to look at 300 different properties to find one. So we're extremely picky. When we do finally get one, then what we do is we go in, we're buying them under market value, 20 to 30%. Like, this is a really beautiful time to be buying right now. We do deep market research. We build relationships with these brokers that really will not award you the deal unless you're proven to close. So that we actually broke through that beginning is something that most operators will never get through. But once you're in the club and you've proven to close, then you're going to get that opportunity. Then we do deep underwriting. Joe, our acquisition specialist, he has about $1 billion in experience there, and he does a deep underwriting on that. Then we go in, we negotiate. John and I, we've negotiated tens of thousands of deals through the years. Then at that point, we do deep due diligence on it. And then from there, we build out our slide deck. And that's where in the next couple of weeks, we have 114 units. I'm kind of spoiler alert coming down the pipe. But at that point, we've done all the due diligence on that, and we're able to actually map out what our projected cash flow will be, or distributions, what our overall returns will be. And then at that point, we do our monthly communication on an ongoing basis, and then we execute on our business plan. And that's where, John, maybe I'll pass that to you. with the execution of the business plan, maybe kind of in a succinct way, when we go and we take an asset over, on how we're able to actually go and not hope the market goes up and hope the value goes up, but we actually force it, which is really puts the odds in our favor.
That's right. So Mark touched on, we look for areas with population growth, economic diversity, businesses moving to the area. So we do a deep dive into that market. Once we find a deal within that market we like, we get into that business plan. And so for us, Mark touched on this earlier, we want our cake and we want to eat it too, right? We want to have that cash flow and that appreciation. But the beauty of the deals we do is these are value add deals. So typically buildings built in the 80s, 90s, or early 2000s that, either A, have been maybe mismanaged or managed ineffectively, or maybe just simply dated. The units haven't been updated, the amenities are tired, and the building just looks worn out. And so what we do is we force appreciation, right? So these transactions are a product of the net operating income. So with a 5% cap rate, which is on average what typically multifamily buildings trade for in a normal market. So right now, it's not really a normal market. So our most recent deal, we just actually finished up, not the one that Mark just touched on, but we're buying at a 6.25 cap rate. So, deals are kind of effectively on sale right now because of some overbuying in the overheated time from 2018 to 2022. So all that said is we like to attack and we go in hard and we go in fast. In fact, if you don't mind flipping to the next slide there, that might be great, Addie, if you don't mind doing that. But basically, what we want to do is in the first 28 days, make a major impact because these buildings often trade every 4 to 5 years on average. So for example, at our Largo property, we have a resident who's been there 12 years, who's seen 4 different ownership groups. And what often happens is a new ownership group comes in, nothing really changes, but the rent goes up. And so, it's just not a great feeling. And so we want to kind of buck that trend. So when we come in on day one, and when I say day one, we close on a Thursday, on Friday, our construction team is on site. We're pressure washing. We're starting the painting. We like to refresh the exteriors. We put in all new door hardware, all new lighting throughout, so it's safe and secure. So bright lighting in all the breezeways. We rebrand, put all new signage throughout. And within that 28 days, we also refresh the amenities. So at one property, we tripled the size of the gym as an example. We also reconfigured the pool. Added some more like couches and seating areas and relocated a grilling station that was within the pool area and built a dedicated grilling area just outside of the pool with some games like cornhole and horseshoes, and just created some more community gathering and meeting spaces. So at the end of that, we actually go in, and by the way, we're also renovating a handful of units in that first 30 days. So we now have a model set up. We have a refreshed leasing center, an entirely refreshed exterior, and amenities package. And then we do a great welcome tenant event and we do some giveaways. We bring in food trucks like Kona Ice, little frozen ice treats and, welcome the community, introduce ourselves. But most importantly, we walk around and get a lot of feedback. And so what we found by doing that within that first 30 days, we've actually now demonstrated to the residents that we've actually provided you with something of value, a nicer community that you can feel really proud of when you come home at the end of that hard day's work. And so what we found is when we go and ask for that renewal, and maybe we're bumping the rent 3 or 4% or maybe 5%, depending on where their rent is at, to get it to that market level, they're accepting. And then as we renovate those units, we're achieving premium rents because we're taking a unit that maybe, in one example, at Largo is one I can look at, the average in-place rent was $1,200, and we're getting like $1,900, $2,000 on a renovated 2-bedroom, 2-bath plans. Because what we're doing is we're renovating them to a level that feels very much similar to a brand new building. So granite countertops, stainless steel appliances, all new plumbing fixtures, new cabinet fronts, sometimes replacing the cabinets if necessary, new hardwood flooring, etc. So basically the premise in our thesis is that there's this sort of a hometown hero, we like to call them. So those are the firemen, the police officers, sheriffs, nurses, teachers, the working middle class, and they often don't have great options. And so a brand new A-class building that just got built down the street that's dealing with the impact of maybe say the tariffs, the rising materials costs, are delivering units that are, 25 to 30% smaller than our units, but at a much higher rent. So for example, they might be charging $2,400 to $2,600, but over at our property for $1,950 or for $2,100, they can get all that great stuff and have this new unit that feels fresh and clean and beautiful, but at a discount. And so that's how we've been able to outperform our pro forma on every single deal we've closed. So we would say this 28-day transformation is really like something that's very unique about us that no other operator does and has led to a lot of our success.
This is a big one. This is where I would say is we'll call it the trump card in regards to us and myself personally not buying further assets in Ontario. And I'm a broker, and we still do over 1,000 transactions, 1,000 sales a year there. So I see deals come up, but the problem is you get one bad tenant and you're doing well in a property, all the best getting them out. 12 to 18 months is what it could take. And we've all heard these stories. And the problem is now the word is spread in regards to the tenant base, and they know how to navigate the landlord tenant board. And the other challenge is if you have a problem tenant, they just roll over into the next year lease. Whereas down south, we just don't renew. If there's a problem tenant and they're causing disturbances and making it challenging, playing loud music and not paying the rent on time, you just down south in these markets, we just don't renew. And that's just part of the culture. And so landlords, for us, our approach works really well down there because we can actually be compensated fairly. We're huge value guys. You probably noticed like in our businesses growing up, the reason why we've been successful is because we give a lot of value. And when it comes down to the resident base and landlords in the past, unfortunately, it's been this, okay, I'm going to kind of both take as much as we can. And for us, we've kind of flipped that on its head and said, hey, listen, we're going to be like massive givers. But in these markets down south that we're investing in, it allows you to actually be fairly compensated. And that's why we're seeing over $300 rent lift on average per month per unit in our assets. We're overshooting because we've taken this approach. And the markets that we're investing in allows us to do that effectively.
So two-pronged approach, obviously, by the looks of it. You are buying it at a higher cap rate. You're going in and increasing rents. You're finding some operational efficiency. And then are you also projecting that there is a cap rate compression when you're actually looking to sell?
That is correct. So we have access to a treasure trove of data from multiple data sources. So CoStar is one that we leverage pretty heavily. And so they have forward-looking projections on cap rates. We can also just look at the history, right? And so, as I mentioned, 5% is generally where these buildings trade at. So what we're experiencing in the market right now is somewhat of a product of greed. I think there was a sort of this idea the party would never end. And so in the United States, post the Great Recession, our Federal Reserve basically effectively had 0% interest rates for an extended period of time, the longest period of time in history. And so it was cheap, easy money. Excuse me. And so what started to happen is operators started to get loose. And by that, I mean, they would say, for example, take on an interest only loan. And they're thinking, well, gosh, rates have stayed low for so long, they'll continue to stay low. Well, we all know what happened, the pandemic, right? And so when the pandemic occurred and the global economy froze for a period of time, inflation kicked in a big way in the United States. And in 2021 and 2022, the Federal Reserve tripled interest rates in a period of about 12 months. So somebody who had a deal that worked beautifully at a 2%, 2.5% interest rate now have a 7 or 8% interest rate. And so they're underwater, they're upside down, they can't pay their mortgage payments. What's happened in the past is the banks would be pretty quick to foreclose, but I think the banks finally got smart and realized when they did that in the past, say, for example, in the Great Recession, then these large institutional private equity firms like Blackstone came and bought everything at a deep discount. And then 3-4 years later, when the market corrected, they made these massive profits. So the banks have been more likely to extend and pretend. That's kind of the term you'll hear in the industry, where they'll extend the loan and just pretend like there's no problems and hope it all kind of works itself out. But where we're at now is some of these operators are just at a point where they simply have to sell. And so the data we're seeing is that on average, multifamily buildings are selling at a 25 to 30% discount to those peak market values. So that cap rate expansion is a product of just what we're seeing in the marketplace with some of the undisciplined buying that occurred prior to things turning down. So we still underwrite conservatively. So by that, for example, CoStar says, well, we think this area of Tampa will have a 4.75% cap rate in year 2027, 2028. we're going to underwrite it about 50 basis points higher. We're going to say 5.25. So we don't just, assume that the forward-looking forecasts are correct, because we all know it's impossible to predict the future. But we're also looking at historical data on where these cap rates trade. Are these buildings trade at those cap rates? So yes, we are expecting some cap rate compression, to put a bow on it, but we're not going in aggressively with those cap rates. We're still keeping it conservative.
Follow up to that, John. You mentioned a bit about the debt markets. So just kind of curious how you guys are thinking about when you underwrite, what kind of debt you're putting in place, loan to value, and then all of a sudden, a lot of times operators will put in a bridge loan and then convert to permanent financing. Obviously, in the US, there are opportunities to lock in fixed rates at a much longer period than we do in Canada.
Yes.
So just talk a bit about the debt cycle and what you guys do to really help manage that interest rate
Yeah.
risk and really help investor returns.
No, great question. So going back to that hotel conference room market I mentioned, one of the things we thought through were, what are our 3 golden rules? Now, when we sat down, we said we have to come up with golden rules. We came up with 3. So one is, we only buy deals that cash flow on day one. So yes, it may be some mismanagement. Maybe there's some bad reviews on Google. The property manager doesn't care. We could solve that easily. Or maybe it's just a product of, once again, it's just tired and it needs a refresh. So cash flows on day one is number 1, because we want to know that if something happens or we have a delay in construction, we're not going to have any issues. We're still cash flowing and we can weather that. Number 2, we always have strong reserves. So we keep minimum 3 to 6 months of principal and interest in the bank for a rainy day. That will depend on the cash flow that the property is currently throwing off. So if it's lower cash flow, we have higher reserves, higher cash flow. That might be an opportunity to get into that 3 or 4 month period. And then on our renovation budget, our CapEx budget, we always net it up by 10% for contingency. But the one to answer your question is, we only do fixed rate financing. So the 2 main agencies in the United States, they're government sponsored entities. So Fannie Mae and Freddie Mac, those are the 2 that we work with primarily. And they offer 5 and 10 year mortgages on assets of this nature. Often you can negotiate a few years of interest only. But flexible prepayment penalties. And yes, those prepayment penalties are factored into our underwriting. So for example, on most of our deals, we may have a 1% prepayment penalty if we exit, say, year 3 or 4, but that's factored into our underwriting. So it allows us to make very good projections and make very good decisions, because we're not guessing where the interest rates might be in a year or 2. We know exactly what our payments look like throughout the entire life of the loan. We know exactly what it'll cost us if we decide to exit a little bit early. At the end of the day, for us, it's about getting the most money back to our investors as quickly as possible. So we can't rush, right? We have to operate. We have to get the business plan done. But generally, the way we structure our deals is, we'll have completed the renovation program, because I think it is worth noting, we don't just kick everybody out and renovate everything all at once. We do it slowly, like 4 to 5 units a month. And what that looks like is, if somebody's up for renewal and we offer them a renewal, but they reject it, maybe that rent is a little bit higher than they can afford or that they were wanting to pay, or maybe it's a life change. They, got a new job or have a baby on the way and just simply need more accommodation, or maybe they're buying their first home, which is something we're always love to see. We now have a vacancy. So that unit immediately is renovated in 3 to 4 weeks. So we're able to keep occupancy up while renovating. So after that end of that 2-year process, once the plan is completely executed, we start getting with brokers, right? And one of the things we do value is those broker relationships. So we generally would work with a broker who brought us the deal. They already know the property very well, and ask them to provide us with a opinion of value. So if we find an opportunity, say in year 2 or 3, to exit and hit those return metrics we promised our investors, we would probably consider doing that. So these are 5-year holds. We do have an optional 2-year extension if there was a black swan event or something happening, and we just felt it was in our investors' best interest to hold it a little bit longer. But we want to get that money back to our investors as quickly as possible. So that's where we always negotiate a flexible prepayment penalty, and we know exactly what it is, so we can model that in. So if that opportunity arises and we could exit early, we could do that and still get our investors top tier returns.
I'll follow up on that. You're looking to cash flow to your investors. You've got a pretty, I would say, ambitious, intensive plan to renovate the units, put a lot of capital. It all costs money, right? So me as an investor looking at this thing saying, I gave you 50,000, 100,000, whatever my capital is. Are you going to be coming back and calling capital for me for the next 5 years just to pay for all this? How do you guys manage the cash flow side of it?
So we raise exactly what we need to do 100% of the renovations, from the exterior to the interiors. Now, candidly, there could be an approach where we actually only renovate 60 to 70% of the interior units. We want the money there in case we feel like in order to get those returns, we need to do the full project. But we also have to think about is who's the next buyer? And so what we can kind of do is sort of prove out the success and say, hey, look what we've done with 60 or 70% of the renovations. Now that another value add group can come in behind us and finish the plan out and get some of those returns for themselves. So at closing, the capital we raise covers the down payment. It covers 100% of the renovations that we plan to do. And so, at this point, a moment, we've never missed a distribution and we have not had to have a capital call. And the way we underwrite our deals, we would hope that would always be the case into the future, because once again, we're getting fixed rate debt. So, we have to be very cautious, right? So it's also looking ahead to say, for example, to see what permits are being pulled, because I could go look today and say, gosh, there's no new supply in this market. What a great market. But if I'm not being careful and diligent, then I may have missed that there's like 7 permits that got pulled in the last, 90 days. And I'm gonna have a lot of competition coming in 2 to 3 years, right? So we're looking at so much data in the submarket, what competition is coming, what is the style of that competition, and is it something we need to be concerned about or thinking about before we even make a decision to pursue a property? We would not anticipate any capital calls because we raise the capital on the front end to execute on the business plan.
And it's important to note just quickly as well, when we're doing our renovations, like we're hitting our budget and we're not doing any drastic renovations. Like we're doing kitchens, bathrooms, flooring, paint, light fixtures, and overall landscaping. We're rebranding the community with signage. At the end of the day, when you're not doing massive breaking down walls, that's where you can potentially break the budget. And so we're renovating these units because we're doing scale from like $12,000 to like $14,000 a unit. We're hitting our budget. So not only are we hitting our numbers in regards to what it is, and now it's rinse and repeat because we have the relationships, but we have that 10% contingency in there as well. So there's we'll say some grace. The other part of it is the due diligence on how deep we go, that if we think something is going to potentially come up down the road, like we're budgeting for that up front. And so we do a deep underwriting before we do our due diligence to be very conservative. And generally what happens is when we go in and we do that deep, we do a property condition assessment where we go deep and we bring in all the professionals to assess. Generally, we're peeling back what we think we need because we were over conservative at the time of making the offer. Because for us, the goal is not to come back and retrade a lot. We want to be very conservative when we're going in, but not doing the massive reno in regards to like breaking walls. And, that's where we're able to be very simple, rinse and repeat. And we've been hitting our numbers up until this point. And there's no major changes. Even with the tariffs, a lot of the stuff we're getting locally, and we're not spending all that for steel and material to build these. This is like, think of it like you're renovating an apartment that is 700 to say 1,000 square feet. Like John said, do 5 a month and we get in, and it's rinse and repeat. You get deals when you do more. It's based on economies of scale. And so that's why for us, and I have experience having multiple homes, 50 different properties, 50 different houses, 50 different places you're renovating. This is like 114, for example, all in one spot. And so you can curate a community, a culture, and you can really do a lot with way less money. When we start to say what the renovation costs are in Ontario, people are like, that's crazy. Like $14,000 to renovate a full unit, stone countertop, stainless steel. And so we're very pleased with the execution side of it.
Yeah. And just to add 2 little final points, sorry to interrupt, but for example, in Florida, right, it's very hot. So for our Largo property, we actually budgeted for 45 full HVAC replacements. We didn't think we would need it, but we just wanted to have it in there in case, right? And then the last point I'll make is that when Mark talks about this rinse and repeat, we actually use the same renovation package across all of our assets. We work with a designer who helped curate that design package. She helps us source some materials at great cost that look beautiful but don't break the bank. But we're not going in and going, well, maybe on this one we use this, or maybe on this one we use that. It's like the same stuff everywhere, because what we're actually doing is creating a whole other brand, Faris Residences. And as we grow and scale, like my perfect goal would be if somebody's moving from Tampa to Charleston, they go, gosh, I hope there's a Faris Residences up there because I know exactly what I'm going to get. I'm going to get great service and a beautiful unit. So it's a very standardized approach across all of our assets.
Are you guys buying like trailer loads from China and doing all these renovations?
Well, you know what it is in the United States, there's a handful of these large suppliers that, this is what they do. They work with commercial operators just like us. And so we formed a relationship with Syntex, and there's another group we're working with out of Charleston that we're testing. But some of the materials actually flowing through more likely Vietnam, actually, than China. So we haven't been hit by any of those tariffs yet. We pre-purchase where we can. So, for example, we found this beautiful chandelier that our residents just love for the eating area. So we have a Connex shipping container nearby one of our properties that we can, sort of just put the materials there. And so they're ready, we can pull them out. So where possible, we pre-purchase, but we also negotiate long-term contracts with these guys and secure pricing. So, I will say on our Largo deal, we budgeted 12,000 a unit and we're hitting that number, but going forward, we've been budgeting 15 to 16,000 a unit and falling below it, but just knowing we may see an increase in price in the future, right? So it just goes back to conservative underwriting. You just have to try to anticipate these things as best as you can. And look, what we're seeing, I'm here in the States, and to an extent, it's his negotiating style, right? He throws out these big numbers. We're starting to see it settle down. And, I was actually told a couple months ago, oh, stores' shelves are going to be bare because of the China tariffs in June and July. And I walk around Target and it looks about the same as it always has. So I do think it's been a little overblown, and I do think the dust will settle, but it's all about just, being intelligent. So we had to increase our per unit budget going forward, just knowing that we may be impacted in the future.
So you guys have mentioned you guys look at about 300 deals before making an actual transaction. So your minimum criteria that you have pointed out in your slide is like 1980s or newer, value add component, 5% plus cash flow, 15% plus annual return. Has to be low crime, has to be in an increasing population. What are some of your red flags when you're looking at these deals aside from this? Like if you see something that it's like automatically a no go for you guys.
Yeah, there's one there, number 8, that we definitely is always top of mind. It's affordability. So we want to make sure that after we renovate a unit, that rent would be no more than 35% of the average and medium income in a 1 to 3 mile radius of that property. So that's one of the first things we look at is affordability. In a perfect world, it's at 30% or less. So the southeastern states over the last 10, 15 years have really experienced the renaissance. So variety of factors, remote work, post-pandemic, people, I think, have become more health conscious really over the past 15 to 20 years, seeing the value of being outdoors more. So sunshine. So the Sun Belt is what we colloquially refer to that area, basically from Arizona down through Texas, all the way up to, say, the Carolinas and down to Florida. And so that's where the population of the United States is moving. So there's net population growth in all these states. But one of the bigger factors, like I'm in Atlanta, and I will say post-pandemic, it has changed a little bit. But back in 2021, the average home value in Metro Atlanta was $275,000. It's now closer to about $425,000 a day. But compare that with Los Angeles, where the average home value is $1.2 million. So it's the idea that somebody can live in Charleston and make like a third of the income of somebody living in South, say, San Francisco, and live a nicer lifestyle in Charleston. So the affordability is a big component of it. The red states, that the Sun Belt is generally more Republican dominated. So you see lower business taxes. Florida has, for example, no state income tax, nor does Tennessee, nor does Texas. Georgia and the Carolinas have very low income taxes. So for the average taxpayer, they're effectively not paying any state income taxes. So that's driving a lot of that population growth as well. So even gas prices, right? I mean, we have so many ports in the United States. The United States have more ports than basically the rest of the world combined. So we have easy access to materials coming in. Gas prices are lower in the red states. So just a variety of factors are driving people into these states. But we still want to look at that affordability. You touched on crime. You see crime everywhere. In my community I live in, it's kind of the premier suburb of Atlanta. But you go draw a radius around my house, you're going to see a little bit of petty theft. You're going to see a DUI. You might see drug possession and maybe some domestic violence. It's just a fact of life. Crime exists everywhere. But if we see shootings, like we don't go there. It's just not going to happen. So we want to make sure it's a safe community where people can feel comfortable coming home at the end of the night. But one of the bigger ones that's not listed here is actually what we call economic diversity. So, for example, like Myrtle Beach is a great little pocket. There's some great opportunities, and we've actually looked at a few, but the reason we always back off, it is so tourism driven. And this year, these areas are seeing a big hit. People are being more conscious with how they're spending their money. So, for example, in Myrtle Beach around Memorial Day, which is a big holiday here in the United States, their hotel's occupancy was at 70%. It's typically 100. So we wouldn't want to go to an area that's just dominated by tourism or an area that's just dominated by one major industry. So Charleston is an example. Major military bases nearby. That brings defense contractors. Boeing's in Charleston. Volvo has a manufacturing facility within about 10 miles of one of our two buildings, and the other one's like a little bit about 12 miles away. Also has not only just the manufacturing, but it's also their tech hub for the United States. BMW is about 45 minutes away. So we look for areas that just aren't relying on one industry. So that's one of the other things we look for. We just don't want to go into an area where if like the paper mill goes out of business, like half the town loses their job, right? So that employment and economic diversity is hugely important to us as well. Tampa, strong on banking finance, also has a strong military presence. And by that, I mean mostly the defense component. So the manufacturers necessarily the basis, technology hubs. So it's just this idea that if one industry or if there's a little bit of pressure, we're a little more recession resistant because of the diversity of the employment. And one thing we do know about the United States, we spend $1 trillion a year on defense, right? So if Boeing and different defense contractors, their faucet never turns off, right? We like looking for areas that have strong economics that aren't going to be impacted. Healthcare, right, is another big one. As the baby boomers age, they want to be close to great healthcare. So when we have a big hospital system in an area that's providing great, well-paying jobs for nurses and technicians and things like that. So that's definitely something we look for. So if it's not there, that's a huge red flag.
Follow up to some of the locations that you're picking there. A lot of Canadians invest in the US, specifically Florida. With the weather patterns more recently, people are seeing some pretty massive increases in their insurance specifically. And so look at some of your locations. Obviously, you can't foresee what the weather is going to look like. You can underwrite whatever you want, but weather can be a challenge. How do you manage some of those risks? And of course, insurance, because I mean, even here in certain areas in the US, carriers are actually leaving the whole state and not wanting to insure. So how are you managing that kind of insurance and climate risk?
So the first thing we do is actually in part of our underwriting, we'll actually go and get hard insurance quotes. We got a very incredible insurance broker. And so, for example, the state of Florida recognizing that pressure because carriers were leaving. Now that has shifted because it's kind of the beauty of the free market. When there's a gap, somebody comes to fill that gap. So a lot of carriers have come back, but we actually went with the state sponsored program on our Largo deal. And so we had that number underwritten into the deal, and we just assume increases every year in our underwriting model, not too dissimilar from how we treat property taxes. But similarly, even with property taxes, we work with a consultant called Ryan Tax Group that does the good, better, best projection. And actually part of their services post-closing is they'll go argue for a lower property valuation post-closings, and then they share a little bit in the savings. But hugely important, I will say. We still love Florida, but it's part of the reason we ventured out into the Carolinas and into Metro Atlanta. Just less weather risk there. There are risks of hurricanes in South Carolina, but it is like 70, 85% less than in Florida. So another factor is we look at the flood zone. So all of our properties are considered flood zone X, which means it's either not in the 100-year floodplain or it's protected by a levee from flooding and has not had any flooding in that period of time in a meaningful way, right? There's a lot of retention ponds, detention ponds in these areas. So maybe that rises up and your parking lot might get a little wet, but no flooding. So that's another factor. But what was amazing is because of our 28-day transformation, now we didn't really anticipate this, but on our Largo deal, when we closed, we were paying $1,850 a door per insurance per year for that building. Deal still penciled out, so we took it down, but we went in and we did a lot of preventative maintenance just to make the property look better, but also just to be smart, right? So we cut tree trim, any limbs that were sort of hanging over top of the roof, we trimmed those back, we cleaned it up, we actually regraded some of the properties. Candidly, it didn't look bad, but it also helped with water management. And what ended up happening is when our insurance carrier came back up for their annual inspection, our insurance actually went down to $950 a unit, all with the same coverage. We also get loss of income coverage. So for example, if there was something in one of our buildings, so it's like a 10 unit or 10 building property and one of them's down, we actually have loss of income insurance. So we're made whole by that loss of income. So it is definitely top of mind. And one of the first things we look at is this property in a flood zone that we can live with? And are we going to be able to get insurance that will model into our underwriting.
Yes, this has been very detailed. So what I really want to do is get to doing some recap on some of your past deals and see if you guys can just walk us through these deals and what sort of numbers it projected so that we can stay within our 1 hour mark. So I'll let you guys take the lead and tell us a little bit more about this one.
I'll maybe start off here, John, and then
Sure.
you can fill in anywhere. So you could see there, it's 104 units. This was a really interesting one because right across the street, there's about 300 units. And this was actually part of that community. So this was like a really good stark contrast because we went in, we executed, we got a really great discount, 20% discount. And we weren't the highest price on this, but the way that we structured our deals from our experience, the broker, they felt really confident that we're going to deliver, and we really listened to what the seller wanted on this. So we did our 28-day transformation plan. We executed, and now we're actually overshooting. The $300 rent lift is what we had projected. We're actually overshooting that right now. What's really interesting is that the asset across the street, we have residents saying, holy geez, this looks like a new community. We painted all the exterior buildings. We did all the new landscaping, the outside, the amenities John had mentioned. And they're walking across the street now. We actually have a wait list on our 2 bedrooms here as well. But the before and after, you can see, basically it's like we're making them look pretty. We're opening up the kitchen there, stone countertops there. We're putting dollars in where we're going to get $2, $3, $4 back. So we know based on our experience, like we've sold the amount of homes, we know what sells, and residents buying are really have the same emotions as buyers buying. And so this is where going in, we had bought this at 17.5 million, and the projection on this was 18.5% overall annual returns with a 5% distribution there. We've been hitting all our distributions. There was this in year 2 that's now been increased. And we get calls regularly on this asset from other operators saying, hey, listen, would you ever consider selling? And for us, we're like, hey, listen, we got lots more to go in our business plan, but it's rinse and repeat. And there's a lot more, we'll say, meat on the bone there that we're going to continue to tap into. This is going extremely, extremely well. And the community and the culture we've been able to build here, the feedback of the 5-star reviews coming and some of the initiatives we've been doing it's a great success story.
Yeah, I guess I'll just add to it. So, to Mark's point, so we work with Asset Living. They're one of the biggest national property management companies in the United States. And our on-site team has actually been inducted in their President's Club 2 quarters in a row for exceptional operations and client experience surveys. In Q1, our average lease trade out was 20%. So in other words, we're collecting rents 20% higher than what was in place before, with one unit actually achieving 66% because it just was like, guy had been there a long time. They were paying kind of a lower rent. We renovated that unit, brought it up to market value. So very proud of what we've accomplished at Largo.
That's great. Well, let's talk about Charleston then.
Yeah, this one here is a real goodie. This is actually through a broker relationship. So the broker called us on a Friday, said, hey, listen, we have this upcoming 272 units. So they're 20 minutes apart. We're actually going to sell them as a portfolio. And we said, okay, that's right in our buy box. We're coming. So we booked our flights. There's like 4 of us that all flew in. On Monday, we met with the broker, continued building that relationship. We toured the assets. We toured the comps. Whenever we go and look at an asset, we always look at the apartments in and around the area to verify whatever our projected rents are, that we're confident that we can get it. Because we report on a monthly basis, what are the rent increases that we're getting? And so we don't want to project out and then we'll have mud on our face later saying, hey, we're not hitting our rents. That's not a story we want to be doing over and over. So we're conservative. So we have to verify that. We actually go through and walk through the competition. We meet with the leasing agents there and we walk their model suite and we let them know we're doing market research. So we're straight with them and we're validating. And so we went in Monday, we were there. We submitted the LOI on the Tuesday, boom, wrapped up by Wednesday, and they were going on the market on the Thursday. So this is a real off-market deal. And we got this, we were in around was 153 to 156,000 a unit. This one here was a 2000 vintage. So it was a little bit newer as well, but they were all classic units, well below market rent. A good story on this is that a couple of doctors had purchased it and they had some other assets as well. And the partnership wasn't going well. And we were able to just get it at a real great price. Projected returns on this was the 20%. And we've been hitting all of our distributions here. We're hitting our budget numbers as well. And there's still a lot that we can go on this, but the canary is basically telling us right now with us overshooting our rents that we're actually overshooting our projected returns on this one as well.
Yeah, just to put a bow on that, in Q1, we achieved an average 13% increase on new leases and an average of 6% on renewals. So putting us well above our projections. And so it just goes back to, by providing that initial value and doing those renovations and making the community better, just from a look feel standpoint, but more importantly, from a service standpoint, we're able to accomplish that so quickly. And it's a great deal. We love it.
I guess a bit of a wrap-up question on, you walked us through the US multifamily, you walked us through some of your strategies. As the Canadian investors out there that pay a lot of Canadian tax, when they look at opportunities in the US, how would they enter the US? How do you guys provide a bit of a structure for folks to be able to get involved in some of these deals?
For sure. And I'll just wrap up in regards to the other assets. We did find another at
Sure.
the beginning of this year, 36 unit, that it was actually, generally we wouldn't go that low, but it was actually between these two assets. It was right in the middle. So we were able to get that at a phenomenal deal as well. And that one is overshooting our projected rents as well, that 36 unit. We did recently fill a deal just outside of Charleston. There's over 5 million, there's 66 units that we took down. So that's been fully subscribed and filled right now. But to answer your question in regard to the structure for Canadians, and this is where I went to a cross-border tax expert accountant and Zeifman's in Toronto. And so said, hey, listen, I want a structure that is not going to, it's not going to make our investors file double returns in the US. All of our investors, they're busy entrepreneurs, they're doctors, there's lawyers, they're super successful, and they don't want the extra stress or time. So it's got to be easy. So what we did is we created a Canadian limited partnership, and we do this for every single deal. So it's a single purpose entity or single purpose vehicle, however you want to name that our Canadians invest into. And those proportionate shares flow down to a Delaware limited partnership that actually owns the property itself. And so we'll say 10% of our investors are on the US side. They come in on the Delaware limited partnership, and 90% of our investors are Canadian. They come in the Canadian limited partnership. And the really cool thing is at the end of the year, we give them a Canadian tax slip. So it's a T5013 tax slip. We issue that. And the way that we give the returns back as well, it's return of capital. And I just want to reiterate how important this is that say you put your money in the stock market, you get returns on that. At the end of the year, you got to pay tax on those, right? And so the challenge or the benefit on how we're structuring it is the distributions that are coming back, we structure that as return of capital. And so there's no tax during the whole period for all the distributions, which are coming back in US dollars, which a lot of our investors love having that US dollar. So when they go and travel, they have US dollars ready to go. They don't need to take a haircut every time they go travel down south. So every month, this is this milk money coming in, so to speak. So when we sell the asset in 3 to 5 years down the road, then it's a capital gain. So this is where it's very tax efficient. That's the best kind of tax if you're going to pay it, as you guys know, right? It's capital gains versus regular income. And so if you speak to any of your accountants and you say two things, listen, I'm investing into a Canadian limited partnership and I'm going to actually get a T5013 tax slip at the end of the year. And I've jumped on the phone with many accountants and I tell them those two things. And it's a very short phone call. They're like, wonderful. Thank you. Great. Okay. Because if you don't do it right, you don't structure your deals right as a Canadian, you can have adverse tax consequences, double taxation. I've seen some cases, my accountant came back and said, listen, one of his guys that he knew, he bought a property, didn't consult with them first, and now he's paying 70% plus tax. And so that's not a place that we want to be. And so this is structured extremely efficient, but simply for our investors.
Perfect. So appreciate Mark and John for you guys coming on today. I think it was a very fruitful conversation talking a bit about US multifamily investing. For our listeners, if you want to learn more, feel free to book a call with us at cal.westcliffam.com. Of course, you can listen to our podcasts. Episodes are published weekly. And follow us on the web or join our Westcliff Investor Network. Thanks so much for joining. Anything you want to add, Addy?
Yeah, for anybody that is interested in getting the slides, they can send a text with the word slides to 647-799-2264. They can always email us at info@westcliffam.com. And everybody should know that while The information shared here is for educational and informational purposes only. Please consult with a professional before making any investment decision. Take care, everybody, and thank you for joining.
Thank you.
Thanks for having us.